Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility, and although this could be an equation for opportunity, it's also an equation for risk. So be careful, only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future results.
Good afternoon, good evening, good morning. Welcome to Traders Workshop for today, Tuesday, August 8th. I'll be your host, Tom Schneider, CMT with NinjaTrader. Traders Workshop is a show where we like to showcase our NinjaTrader ecosystem partners. These are people that have developed their own tools and their own services and make them available to you, the NinjaTrader customer. And it's also a great way to understand the markets a little bit better and see where these folks are coming from. We do this every Tuesday at noon Eastern. And, today's no different. And we have a great guest today. He's been on the show before. I've known this guest for a long time. And we're going to be talking about the neat tools that have been created from Go No Go Charts, and I would like to welcome back to the show Tyler Wood, CMT as well, a co-founder of Go No Go Charts. How you doing, Tyler?
Great, Tom. It's good to see your face. I wish we were in 3D, but video conference call will do for now.
I don't know if 3D might be too much for me for this space, but good to see you as well. And it's been a couple months. It was great to see you at the symposium. And connect like we used to in days before. But great to see that you and your partner Alex are join the ecosystem and kind of taking ideas that have been rattling around. I know, and Alex has had in your head for years,
long time,
put them on paper. So with that, I just want to give people a chance to understand who you are, how you got into the business, and maybe how that transitioned into Go No Go Charts.
Absolutely. No, it's a pleasure to be back on. For most people who get involved with technical analysis, we find that their path into finance can be non-traditional. It's oftentimes a skill that people pick up on the trading desk, or they're in a research department and somebody gives them a great book by person like John Murphy or Martin Pring or Charlie Kirkpatrick and Julie Dahlquist, you name it. There are, if I haven't mentioned your favorite author, I apologize, but there are so many great texts out there. But for most folks, they're learning technical analysis on the fly. It's what works in practice, right? For me, it was no different. I finished an undergrad in liberal arts and got into my first job while my wife was pursuing her PhD. And I had a great boss who said, Tyler, you're not nearly as dumb as you look. You would really benefit from maybe an MBA or some kind of background in finance that would give people an understanding of your credibility right off the bat. So I pursued the MBA track. I graduated from the Kelley School of Business in 2011. Indiana University was a great school, and it was a really rigorous management training for people who were running companies or doing fundamental analysis. A lot of corporate finance, a lot of managerial accounting. I felt like I was very well prepared to be a product line manager or brand manager for a big consumer packaged goods company. If I was going into the finance track, then it would be all about evaluating the intrinsic value of said company, right? In the equity space, we look at the management team and their balance sheet, and we use things like discounted cash flow statements to understand how the market is wrong. Well, I got to New York in 2011. And of course, if you're going to be living in Manhattan, you're going to work in finance unless you're a lawyer. And I met these wonderful people, Ralph Acampora and Phil Roth and Louise Yamada. And I think testament to the CMT Association, that network and that community, they took a lot of their time to help explain to me, yeah, but that's not how markets work. That's how companies work, right? And they're two different things. You can use them together and you can have a more complete analytical discipline if you understand both sides. But for anybody who's going to be involved in trading the markets, you're not buying the whole company, you're buying shares. Or in the futures environment or with any other securities trading, what you're dealing with is a poker game of other investors, and they're not always rational, right? Markets are not purely efficient. Not all information is equitably accessible at the exact same moment. So you have these tools, technical analysis, that help you understand sentiment, the position of traders, money flow. You can look at really important basic understanding of price and volume data to get a sense of what the market is telling you. And 2023, honestly, these last few years have been such a amazing case study, right, in why people need technical analysis. I can't tell you how many economists and macro strategists and very intelligent people have been on every financial news network anticipating this Great Depression, right? The recession is upon us. The world is ending. Go buy bullets and canned corn. This is the end. It's the great financial crisis right over again. We've got regional banks blowing up. We've got this financial collapse on the horizon. The economy's in recession. And meanwhile, what has the market done? In the equity space, we've seen growth outperform value. We've seen perhaps the biggest run in the NASDAQ in history, first half of the year. And so you have to find some tools that will help you get away from what you think you know about the markets, or the narrative that, everybody in the world falls victim to the fact that, fear mongering can get in the way of making sensible decisions. So technical analysis for me, the most important part of it was that you can separate your emotions and just be much more quantitative, data driven in your approach, which Wall Street says that's what they're after. I think it's harder to do in practice than it is to say on your pitch deck. And so these technical tools are just an incredible gift to us to help us see what the market's actually telling us versus what talking heads are telling us. And
yeah. So Tyler, a lot to unpack there. First of all, Jim Cagney, my broadcasting partner, would be pleased to hear that you went to Indiana University.
Oh, good.
Son goes there, and in fact, I was out in Indiana, not in the Bloomington area, but in Indianapolis proper. Just great to be in the Midwest sometimes. But
it really is.
What I want to know, going back to your training or back to your schooling, mm-hmm. in the process, and again, this is more than a few years ago. It was like you said, maybe 2010, around there. Was technical, how big a piece of that degree or classwork that you had was technical analysis mentioned? Was it a piece of it at all, or was it kind of shoot off to the side? How did they treat that?
This is no discredit to the faculty of Indiana University. I had some really great professors, but technical analysis in corporate finance courses was it was disparaged. I had a professor who said, if you hear the words technical and analysis come out of any fool's mouth, you're on the other direction. They'll lose all your money. It's total voodoo, stay away from it. And then in my second year, as I was completing the program, I took more advanced quantitative classes, and I had a very astute professor who was teaching us it was a stats class, statistics, and we were looking at some regression analysis. And he paused one day and said, look, I'm not trying to teach you guys how to trade the stock market. That's not the point of this class. But if you would like to dig deeper, there's an organization in New York called the Market Technicians Association, where they spend all of their time and energy trying to unpack some of this data. And so I had heard of the MTA, which is now CMT Association, the Global Credentialing Authority for Professional Technical Analysts. And I think it was given a fair shake in that more quantitative lens, that you could look at, quarterly return on equity going back 10 years and spot trends. But you could also look at price and volume and spot trends. And so in a quantitative model, it's all just data. And the more data you have, the better your output is. So that was a favorable mention. It wasn't always denigrated.
Oh, for sure. I'm just wondering, there are certain universities that have offered maybe more, maybe a class, right? Maybe a class in technical analysis, or maybe more than one class. And then there are some who haven't embraced it, and I think it's a matter of bandwidth and exploration. But certainly, as we know in the real world, what you learn in college isn't always exactly represented what's in the field that you go into, right? Because
Yeah.
things change, and there are always what's the bias, right? Who's your mentor? Your mentor has a huge influence on you, and so if your mentor is into this analysis or that analysis, you could be shaped by that. So just curious. I know it seems like in Richmond, Virginia, it's in the water, right? Whereas in Indianapolis, not so much. But good to know. And it doesn't make Indianapolis bad and Richmond good. It doesn't. It's not.
Right. You know, this CMT Association has done a lot of really good work in that space. They've developed an academic partner program. I'm happy to say I had a big hand in that. And the outreach to universities worldwide has been received with great fanfare. Actually, we occasionally still have meetings with some professors where they're quite skeptical at first, but I think the field of behavioral finance has opened the door for traditional fundamental only evaluation to leave some space for the fact that maybe markets aren't purely efficient, maybe humans aren't purely rational, and so there's a gateway, I guess, to showing off these tools. And those behavioral psychologists gave language to things that technical analysts have known about for hundreds of years. Meaning, when they talk about heuristics and the herding behavior, that mentality that you stick with the group, we've been talking about price trends for a very long time. So what works in practice hasn't always worked in theory, but now I think it also works in theory because there's a new set of language to describe it.
So let's talk about some of those items, right? So you were steered, or MTA came on your radar when you were in college in a master's program. You explored it. Obviously, you explored it to more depths than most people, right? But I can imagine your first exploration into technical analysis is probably similar to mine, or even Jim's, or even Mission Control's, anybody, which is, if you go to any software program, there is a wealth of indicators, right? And as you get more experience and get more exposure, you kind of understand it's like a toolbox, right? If you open a toolbox, you go to the store, you can buy a 128 piece set toolbox, right? You're going to be able to do many things with that, but you might not need every tool or any one project or even multiple projects.
Absolutely.
So what was your experience when you saw all of this? What was your thinking? Like, how did you digest the fact that there were all these indicators, and where do you start, I think is kind of the question.
I'm not too proud to admit that I made every mistake possible. Everything that anybody has gone through that's steered them wrong, I did the exact same thing, which is to say, you start going through the CMT curriculum, or you open up a charting platform, and there are hundreds of indicators you could apply to your chart. So you start reading about volume studies, and for a while it seemed like volume was the answer, right? That you can't really trust all the price movements. You got to see if the market participation is there to support it. I went down the volume rabbit hole. Then I got into momentum, and I mean, just think about how many different momentum indicators you could, commodity channel index, and you can look at stochastics, use some RSI, and not even just looking at the tools, but also starting to read about the men and women who were creating these things. So Wells Wilder in the 1970s in the US was trying to find a tool that would help people deal with a range-bound market. So you start looking at momentum oscillators in the context of what the creator was tackling. What was their challenge? Well, it was, can you spot the top of the channel and get an exhaustion signal that's going to help you be positioned for a reversion to the mean? Fantastic. But that's not the market environment that we've been in consistently since 1975. So we, or since 73, I should say. We need to understand where those tools were created, and then how we could use them in our own context. So you move on from George Lane in the 50s and Wells Wilder in the 70s and their concept around momentum studies, and you read the works of Constance Brown and Andrew Cardwell, who talked about how you can use momentum oscillators when you're in a trending security. So it's not oscillating, overbought to oversold, but maybe overbought to neutral and then back to overbought. And you start to see that they're still powerful tools. You just have to change the way that you apply them. But Tom, I think to the bigger point, when people start to learn about trading, if you are studying with somebody who is trying to shape you and mold you into their one trading style, it's challenging to find something that fits perfectly, right? Trading is deeply personal, has to do with your risk tolerance, how you deal with uncertainty, your objective, right? Are you looking to rebalance your portfolio once a month and just stay on the right side of trends, or are you day trading intraday? So just mimicking one other person's trading style can be really difficult or hard to stick with it for the long haul. Instead, I think what I took away from all of these tools was you find the ones that work for you, and you try to simplify your process, right? So the danger that I ran into with going down the rabbit hole of each and every study was my chart started to look like a bowl of spaghetti, right? How do you take all of that analysis and then translate it quickly enough to a trade decision? And so the more complexity you have in your analytical process, the more contradiction or you're going to fall victim to those same behavioral bias that everybody else does, where I don't have confirmation from all of my signals, so I'm going to wait to take this trade. Well, do you wait and miss the first 80% of the move? Do you wait too long to get out and get destroyed on the other side? So I think that translation, and every technical analyst will tell you, the analytical part is different from the money management part. And so when you try to bring those two together, you need a simple set of tools that's going to show you a complete picture, but be able to be action oriented. You have to be able to place the trade with some confidence. And that's what led Alex and I to Go No Go charts.
Right. And I hear you on the cluttering, I'll call it cluttering of the charts, right? It's easy to take any one of these indicators. To me, they've been the classic ones for sure. They've been vetted. Let's call it that. Let's call it vetted. You might not like it yourself. It might not pass your personal test of what you're trying to do. Or I know one of our broadcast partners on our Thursday show, Develop Your Edge, he likes a Bollinger Band, but he has different settings. He doesn't even show the moving average. I mean, this is like, wow, blow your mind, right? Why wouldn't you show the moving average? But he has his reasons. So he's vetted it in his own way. But each one of these indicators, in my mind, oh wow, this is a great thing. This is interesting. I know what it does. But even then, you can get into I wouldn't say analysis paralysis, but certainly where am I looking on my chart to find out, what's happening, and especially for our audience who are generally day traders, what's happening now. And where do I need to be looking? Because I can easily put on, and I'm kind of building this behind the scenes right now. The indicators that I like, generally, that tell me something. Maybe Mission Control, we can share this chart. I like all these indicators, right? This is volume. I think especially towards the end of the day on an intraday chart, I like the volume. Talked about that many times. Stochastics. MACD, RSI, all of these things are variations of telling kind of what you were saying, momentum, right? Volatility with the Bollinger Bands. We could even throw on ATR. That adds another panel. We've got two moving averages, right? Throw in trend lines, throw in Fibonacci retracements, throw in Elliott wave, like all this great stuff. And all of a sudden, you've got something that really is powerful information. It's almost like jumping behind, the wheel of a jet when you're learning how to fly a Cessna 172, right? Like it's almost too much. You know what each dial does, but looking at them all together. So, that's something that I know I spoke with Alex about many years ago. We spoke about many years ago.
Mm-hmm.
And, I think it's a really interesting story that you guys ran with it and said, well, how can we make this easier? Now, I will say, so you've been in the process of getting the indicators on NinjaTrader. You've come real far. What was the analogy you used when we were talking earlier?
I think you were talking about your commute home from the Midwest to Long
Yes.
Island, and that
Yes.
the first 90% of the journey, it's great. You're driving 85 miles an hour, and it's clear sailing, and then you get to the George Washington Bridge,
Right, right.
uh, and the last 50 miles could take you another 5 hours. For us, we've had the pleasure of working with really great programmers to implement the code in lots of different languages, and so we've got the tools for NinjaTrader. It's all ready to go. The George Washington Bridge for us has been just getting the e-commerce component. So I know downloading that packet, installing it into your version of NinjaTrader. I'm sure you were scrambling with that in the background, and we're gonna get that process ironed out and super easy for everybody on NinjaTrader. But what I appreciate about a chart like this is it's a really responsible approach. So if you talk about, Tim Hayes at Ned Davis Research, or Ari Wald at Oppenheimer, or Jeff DeGraff at Renaissance, or Craig Johnson at Piper Sandler, or name any analyst that you see on CNBC, they're not relying on one indicator. They have a set of tools, and they're looking at the weight of the evidence. They're going to look at everything like this on a single security. But then they're also going to look at market breadth. They're going to look at relative performance. They're going to do a lot of ratio charts. They're going to look at multiple time frames. And that was probably one of the greatest lessons I took away from the CMT program, was that you're trading intraday. Perfect. That's your time frame. And maybe you're executing on a 30-minute chart. Well, let's take a step back and look at where the daily is at, maybe even look at where the weekly is at in the context of, what's the broader direction of the market. We're in a bullish environment in the US equity space. So then when you're taking your trades, that you're trying to trade in the direction of that primary trend, or maybe your strategy is mean reversion. So you're looking for the parabolic move to then move backwards. Whatever your style is, you have to pay attention to what the primary or secondary trend are. And we see that play out even in the institutional side, where big PM has large institutional pools of capital to take positions on. They've got a longer term horizon. They might want to be holding that for months to years, or years to decades if they're pension allocators. But they're going to hand that trade down to the trading desk, and then that person's going to be looking for sensible entries intraday. So both are going to use technical analysis on totally different time frames. And I think for Alex and I, when we're putting together what is go no go charts, the sensible approach, the weight of the evidence, is what was most important to us. And then having that process be consistent, because we know if what we're trying to do is capture the meat of the move of a trend, to be responsible in our approach to buying dips, adding to position, all of those things that the TikTok traders really really embellished on during the bullish phase. We want to have a rules-based discipline. So the charts, the idea is to be able to see quickly what that weight of the evidence is by combining the stuff that's most widely used and heavily back tested, and none of the squirrely stuff. It's not our opinion. It's just what the market is telling us.
Right. And you made an interesting point about pension plan managers, or even portfolio managers. They do, I dealt with the trade executioners, right? They were getting instructions on what to trade,
Mm-hmm.
and what volumes to trade, but they were their job was to get the best price, right? And that's almost like a day trader, right?
Yep.
You've already pretty much chosen your market. Yeah, maybe you have to make a decision of which stock index future, or maybe you only trade crude, so that's moot.
Mm-hmm.
But you're still doing that idea. You have that idea of I have to I want to get the best price. I want to get a best fill. I think the market's going to do this. I think my bias today is this. Where are we now? Can we go against our bias a little more? Are we actually in that bias? We need to jump in. So it's really interesting when we think about what types of traders there are institutionally. There are multiple types, and I would say, from a purely a goal focused analysis, trade executioners at these bigger, that trade for a manager rather than, let's say, a hedge fund, where it's a little more or a little less restrictive, I should say. I can choose what I want. Maybe it's a certain sector that I cover, but I get to choose today what I trade. A day trader can still do that, right?
Of course.
But the one thing I think that's true is, understanding those multiple levels of bias or direction or situations in the different time frames is key.
Yes, absolutely. Louise Yamada, I was having a call with her yesterday, and she said, you could look at a bunch of different stocks that had a 5% upside move. Okay, but not all moves are the same. So you could have a 5% move in a well-established uptrend, right? Had a little pullback and now it's taking off again. You could have a 5% move that brings you right to the top of a range, a channel, or you could have something in a defined downtrend and that 5% move didn't even eclipse the latest lower high, right? Series of lower lows and lower highs. So if we're using technical tools to our advantage, we're going to have the context of, well, what kind of uptrend are we in? Is this very short term within a structural downtrend? And when Louise talks structural, ask her about the 10-year. She was talking about a top that happened, right around when I was born. So my lifetime, we've been in a downtrend until just recently, right? Yields have moved above a 40-year downtrend and are sustaining higher. So those are the kinds of structural shifts. And I'm sure for those trading intraday, it's like, that doesn't even begin to influence my time frame. But it's important context,
Right. And to give everybody a little bit of background, Louise Yamada was chief technical analyst at Citi for a while. I know she took over, I think, from Ralph Akampora, and she's been on her own now.
And Alan Shaw, the firm was called Smith Barney before all of the broker dealers got eaten up. But yes, she was head of technical analysis, chief equity strategist, I think, for Citigroup when they took over Smith Barney, and then she's been independent since 2006, I believe. Louise Yamada Advisors.
Yeah, I worked with her when she was at Citi with Ron Dano and Jonathan Lynn, and but back before she left Citi. But awesome. She's great, and she had a great story to tell at the symposium. But what I'm trying to do, Tyler, is I have this. We showed the chart with all the studies on it. I was able, I think, to install this. This is how close we are. I don't know if I'm able to show them on the chart. They don't show up with anything on it. I don't know if there's something that I missed on my end. I do see them on the indicator list.
Yeah.
I don't know if you saw my machine ID, if that needs to be input somewhere, but I'm like so close. I'm on the George Washington Bridge, closer to Long Island than New Jersey. And we say that as a joke. We don't. I know, Tyler, you've had a great experience with the NinjaTrader folks, and Ryan on the ecosystem team are always great. Yeah. I was in Chicago, and I was hoping to meet with one of the Ryans, and it just turned out he was off that day. But shout out to Ryan for helping you with this. It's no slander on them. The e-commerce I've worked with in a previous job, e-commerce is not easy.
Not easy at all. Not easy at all.
You know that.
Yeah. But we'll have lots of visuals on future segments of the show. I think in terms of market analysis, what I think everybody on the line might be interested in hearing is the idea that you can remove any sort of indicator overload or analysis paralysis from your chart, but keep all of the information in the back end. So we have this color-coded price charts, whether you like candles or bars or whatever sort of chart type you want. But the idea is to embed a trend model, right? So think moving averages and understanding end period momentum and identifying a trend using a very long checklist of tools. But then we simply identify 5 conditions, right? Is it a strong uptrend, a weak uptrend? We call those go conditions. It's go for launch. If you're thinking of a NASA shuttle launch, you want to make sure that the probabilities are on your side and all the conditions are ideal. Strong and weak form of a no-go trend, or a signal to get out of a downtrend, or maybe even lean into short positions. And then a neutral territory. And we admire the life and work of Jesse Livermore quite heavily. Pretty incredible story if you haven't read a lot about him. But he said there's a time to go long, a time to go short, and a time to just go fishing in all markets, right? That you only want to be trading when there is clearly a trend involved. And so we have go fish bars when all of those background inputs, all the calculations are in there, neutral territory. Then we have these amber go fish bars. And so just taking that basic concept of trend and combining all the indicators, we moved on from there, and we wanted a single panel, right? Because the idea of confirmation and divergence is so important. And what are we looking for divergences on? The momentum, volume. We embedded all of that into a very simple momentum oscillator, ranges from -6 to +6. So it's a bounded momentum oscillator. But what was most important in that study was having an objective neutral level. So I referenced Constance Brown. Connie did great work on defining how to use momentum oscillators in a trending environment. But when we look at the use case for a lot of the traditional momentum oscillators, it's very subjective about what is neutral. It's even subjective about what is overbought or oversold. And so we wanted to make that crystal clear on our charts. So there's a zero line. And we look at that interplay between trend and momentum constantly, looking for support at zero, meaning momentum surged, and then it came back to neutral. It doesn't go oversold in a go trend. Otherwise, that's a serious divergence. There's enthusiastic selling on that security, and we know that's trouble for a go trend. And then we also embedded volatility. So the four main tools of a go-no-go chart are trend, momentum, volume, and volatility. And if you're familiar with Bollinger Bands or Keltner channels, there's a lot of really great work that's been done about volatility compression. So like a coiled spring, if you see smaller and smaller, tighter price ranges, you see momentum basically go flat. There can still be heavy volume. There can be a lot of trading. But what we're doing is visualizing investor behavior. So in a volatility squeeze, there's a tug of war between buyers and sellers. And we know in markets, when one team dominates, right, let's say the buyers take control, then everybody piles onto that side of the trade. And that's the runaway. That's the breakaway gap. That's where the trend really takes off. So we track volatility compression right in the same oscillator, no extra tools or panels. And we look to those opportunities for high velocity moves in the direction of the break.
Okay, so Tyler, I'm going to say, did you watch the opening range this morning? Because we talked about the spring concept on Bollinger.
Oh my God.
Jim and I had a conversation about Bollinger Bands, and that's how I think of it. It's interesting you think of it like that. So I'm just pulling your chain a little bit. But
I missed that call. I was on with the Australians, I think, at about 6 a.m. this morning.
Okay. Well, you're always welcome to watch opening range.
I'm going to check that out.
We'll give you the link that gets it to you for half price.
Perfect.
Anyway, but I wanted to show. So I want to, Mission Control, if we can go to the chart real quick, because you mentioned the go no go. It's go no go charts and boiling down this information. Now I do want to make a couple of comments. One, past performance not indicative of future results. Get that out of the way, re-say that. But the other thing is, I don't know if these are the exact studies. I don't know if they're the exact, and I don't really need to know. That's more for if you, the viewer, want to reach out to Tyler or Alex and see maybe what they can tell you about what goes into the indicators. But the concept is the same, right? I've got this chart. Right now I have 4 panels. I could have ADX on here. I could have another oscillator like commodity channel index could be on here. I could have this really cluttered. And I've seen those charts. Believe me, I've seen the charts where there are 9 panels below.
Yeah.
But here is what this looks like. A lot of analysis. We've got volatility, we've got volume, we've got momentum, we've got moving averages. That's trend. How do we boil it down? And so let's go over to what Tyler was talking about, which is a simpler color-coded version of the same chart, right? So now I'm not really necessarily looking for very specific comparisons or levels that I have to go over. Is this overbought, oversold? Okay, let's go to the next panel. This sums up all of the information, all of the inputs, and makes a judgment based on those factors. So I don't know, I wanted to show you that it worked, right? And this is the first time I've seen it on a NinjaTrader, so I'm excited. If you want to comment, we're looking at crude right now, and we know that crude is kind of testing those upper limits. Do you want to, explain the no-go and go? I think you did a good job on that, but explain what might be happening. This is a daily chart.
So the thing that really resonated with Alex and I as we were both going through this investigative process as learners of technical analysis was that some of the foundational work, Dow theory, written by Charles H. Dow, founder of the Wall Street Journal, he's talking about evergreen concepts in human behavior. Then you fast forward to Edwards and McGee in the 1940s, much deeper technical analysis on price action. But again, they're focused on price action. And classical Edwards and McGee price pattern analysis or important areas of support and resistance, that concept of polarity is critical to our work. We hope it's critical to your work as well, and need to be able to see price action. So if we're just looking at this chart of crude, massive gap up in early spring that was quickly rejected at resistance, right? Now, the way that we think about trend following is that you want to obey the rules. So getting in go trends, that's a great practice. Getting out of no-go trends is a way to manage risk. And you never know what's going to be on the right side of the chart. But we do know there's only 4 outcomes from a trade, right? Small gain, a very large gain, a small loss, or a very large loss. And as Jerry Parker or any of the turtle traders will tell you, small losses, love those. Like, he loves his losing trades. He loves when it doesn't work out. He's always looking for them, wants to identify them as quickly as possible, because small losses we can recover from. It's that risk of ruin and having a major loss in your portfolio that we have to avoid. So if we stick to our rules, right, we exit anything that breaks trend conditions. That first April to before May, we got to an amber neutral bar. You get out of that trade for a small loss, no problem. But then what we don't know is coming is this choppy drawdown from May and through June in crude. And certainly mean reversion traders could catch, high velocity moves back up, as we saw in early June. But from a trend follower's perspective, we want the conditions to be right. We want to know that the trend has been established. So it's by its very nature a lagging indicator. As Louise was pointing out to me, yeah, that's a great gain within a structural downtrend. So we don't want to get caught up in those seductive relief rallies. We want to participate when the conditions are actually on our side. So here we entered July, and crude begins to take off. That's a weak form go trend in those aqua bars. That means the conditions are defining an uptrend condition, but it hasn't taken its stronger form yet. That trend is unbroken so far this summer. July and August, these last couple of months have been good. What Tom was pointing out is that concept of polarity. So right now we're up at these levels where we're testing prior highs. And the concept is there are going to be sellers at this level, right? If somebody got in after that big rally in April, a lot of investor behavior would suggest that they are waiting to get back to break even to get out. People call that the anchoring bias. So we know that there could be overhead supply at this level, people willing to part with their crude at this price. Here's the important part. If we break through a resistance level, it then becomes a natural level of support. So I'm sure most of you have been trading even longer than I have, but you've seen you break out and you retest and you move on. That's a very common price action move. So what for Alex and I, when we get up to important resistance areas, right, we want to see not only what's happening from a trend perspective, we're in strong form, go trend, but then we would also look to that lower panel, which isn't on this chart right now. I'm going to make sure that we get the full install for you, Tom, for the next time. But we would look immediately to momentum. Mm-hmm. Are we seeing positive or negative momentum? If we've got positive momentum on heavy volume and we've got a move above that resistance area, all bets are off, right? We're going to lean into that trade. So at key decision points, you do want to look at the rest of your tools. What's the whole environment? Where's volume and momentum and volatility at to help us decide whether we stick through this trend? For Alex and I, we wouldn't be selling out as we approach resistance if those other conditions are also favorable. So that's the benefit of the complete go no go chart, is that we do lean on a lot of those tools at inflection points.
Now, a couple things there. The go no go is a long bias, right? So when we're talking about futures trading, we can go long, we can go short. Mm-hmm. We can go short just as easily as we go long if we decide to. So what I would say is the go, giving that long bias, think of it as a, go to the long side. No go is no go to the long side, but you could look at that as a go for the short side. So just to be clear, it seems like go no go was maybe developed with this long bias in mind, but for the futures market, it's binary, right? It's long or short. Yes. The other thing I would say is, you can combine this with something else, right? So I've just taken the clutter. I realized this is a combination of trend, of volatility, etc. But I like volume, right? I'm old fashioned, kind of brings me back to my basics. And what's interesting about this is volume's been pretty static, right? Mm-hmm. Huge drop off last week though, mm-hmm. right? As we test those highs. To me, that's a warning sign. Today, push back up with this huge, we call them icicle wicks. I think that's a Jim Cagnina special. Icicle
wick.
Nice.
Right. Somebody's from the Midwest.
There you go. Big push up by buyers, right? Rejection down here, bring it back up. That to me on increasing volume is good. And so, this kind of almost confirms that maybe this is still a go, and not just a go, but a go in the blue rather than the aqua, which is a stronger, if we look at it like kind of medium and hot or low and high, this is like a high of value. But
on that point about long bias, I personally have a long bias, but we actually built the tools and it's probably a nomenclature thing. They work in the exact same way to the downside. So for short traders, we look at the same thing in terms of trend continuation and seeing momentum resurging in the direction of the no-go trend. So we've got some icons that appear on the charts where you have those conditions where with the go-no-go oscillator, if momentum comes up, testing zero from below. So we've had negative momentum, heavy selling pressure. It cools off, gets to neutral. When it surges again to the downside, that's your trend. That's when you lean into those short positions. And when you see it leave the oversold condition and cool off, you'll get a counter trend correction area. Maybe that's a time to cover part of your short. And so it's designed for anybody in whatever direction they're trying to trade.
Well, it's great to see it on screen and live as it happens using real data. Just real quick, I do want to take a look for those interested at the E-mini, just because we know the story of the E-mini and the NASDAQ. I should say E-mini S&P, the NASDAQ as well. It's been pretty pretty bullish this year, right? As you mentioned, it could be, the best performance of these indices since the beginning of the year for decades. But just interesting to see, like, okay, we've seen this aqua since the end of March. And even though it is kind of flat, I shouldn't say flatlining, but it's sideways, the bias is still bullish. It's a go. And it really doesn't turn off even with this pullback. So, if you've been a bull, and this might be an indication of, well, if I'm a bull, maybe this is time to, maybe add to my position, right? As opposed to seeing something like an amber there. If we saw an amber here, that might be a different interpretation. Say, wait a minute, I've been bullish. Maybe I take off a little bit, but these are the things that you can interpret, less volume on a downtrend. I don't know, that's interesting.
Would you mind, Tom, changing that to, let's say, an hourly chart or a 15-minute chart?
Sure, not a problem.
So, right, we just saw weak aqua go conditions, right? Not the strong form go, but the weak go on the daily. And so for longer term managers, right, there's your pullback, and you look for the confirmation that momentum's coming back, and we take off again. So you add to the position. You're a trend follower by nature. If you're trading intraday, that was a great opportunity for the short trade, right? If you're trading 15-minute bars, you see that pullback, right? Goes to amber, we've got neutral territory, and then strikes a no-go. And then all the way down, you've had these little relief rallies, but it didn't leave the no-go conditions. So from a trading perspective, if you've put your short on, you want to stay with it for the meat of the move. So you find that purple and pink color and you stick with it, and look how much further you got in the trade. I think one of the hardest behavioral biases to overcome is to not close out a winning position too early, right? All of us have this feeling like, I made my 10%, or I made my 15 or 20 or 50%. Well, what if it's a 500% move? What if this chart was of 08 and the 15-minute no-go didn't end for a year and a half, right? The point being, we can all be trend following in that perspective, whatever your time frame is. Now, the context that you get from looking at that longer time frame, that daily chart, as Tom was showing us, we've catapulted higher off of those October lows from 2022. And so getting in front of a pretty strong bull market can be dangerous, but you could still scalp no-go trends, right? Scalp to the short side, but that the general bias of the market is that's not going to last forever, right? And so we're watching for those trend conditions to change, right? Volume's drying up here, and this might be an opportunity to cover some of those shorts. I certainly would look to some risk management discipline at this stage of the trade.
Right, of course, and I will again preface, past performance not indicative of future results, and none of this is trading advice. Right. It's informational only. But Tyler, we're up against time. We're a little bit over. It's always great talking to you. Where can people reach out to you if they want to learn more?
Absolutely. Tyler at GoNoGoCharts.com, Alex at GoNoGoCharts.com, or you can hit our whole team and staff, info at GoNoGoCharts.com. We've got a ton of educational evergreen. If you're new to technical analysis and trying to just even understand, how do we use momentum tools? How do we use volatility tools? We've got a lot of great videos on our site, free, accessible, at GoNoGoCharts.com. But by all means, introduce yourself, shoot us a note, let us know the time frame you're trading in, and let us know how we can help.
All right. Well, Tyler, thank you so much for coming back on. Tell Alex I say hi. It's too bad he couldn't be here today, but we had a great discussion, and hope to get you back here on again and see what else you guys are cooking up. This is great.
Absolutely. Thanks so much for the opportunity, Tom. Great to see everybody, and we'll talk again real soon.
Okay, thanks, Tyler, and thanks everybody for coming. Be sure to stay here. Bars closing 3:15. Jim Cagnino will wrap up the day, this very important day, and In the meantime, have a great trading day. We'll see you later.